Hey everybody, Brian here from quantlabs.net. Just wanted to show you the second uh, video or demo of portfolio optimization from the Matlab Financial Toolbox. This is from another webinar. Just ran this file, this script actually, and it analyzed investment strategies with CVaR, conditional value at risk portfolio optimization. Now, value at risk is pretty well standard in a lot of the institutions out there to assess the value of their portfolio and the risk it brings. As you can see, there's various scripts being run, different ones, and basically what this does, I'm going to give you the links in my blog to the files and the webinar itself. The webinar itself will walk you through the entire set of scripts. So I'm not going to do that. I just want to show you from a high level what it can do. It's using uncovered calls as a strategy. Now, it will calculate your maximum drawdown, your standard deviation, mean on the total returns of all these different market assets. Now, you pretty well can have as many as you want. In my case, I'll be obviously focusing on futures and probably commodities and probably some trading pairs and that sort of thing. And then it uses the geometric Brownian motion to do some calibrating. Gives you the price, the drift, all that fun stuff. Does another calibration, and then does a variety of scenarios against different portfolio simulations, and then it will give you a bunch of statistics and null hypothesis tests on the different covered strategies using the CVaR. Now it's also using the real efficient frontier versus a simulated one. It's using all this data here, the blotter, all the different assets covered at 5%. I believe it's risk. And there's two different types it's doing. It's doing the conditional VAR as well as the MV, which is then Markowitz. And that does two different scenarios on that. So let me show you the plots. So this is the real efficient frontier. This is, as you can tell, is the mean variance. And then this one, sorry, I'm an idiot. Markowitz, mean variance in this part here, and V blotter, it's mean variance. My apologies. So there's different mean variance output of cover call versus without cover call, the CVaR with cover call as well. So just wanted to highlight that to you. I'll give the links to both the files and the webinar. I forgot to mention that there's two other plots as well. There's a mean variance portfolio weights against the CVaR portfolio weights for two different conditions. This is using standard deviation of the portfolio returns. Yes, so that's an important one as well. Hey, now I'm going to show you this one other script. It's part of this package, a CVaR webinar theory. Now I'm going to show you why this is important to me, because this is stuff I'm kind of surprised that people don't really pay a lot of attention to. So let me just run this through the debugger. Okay, so what we've done here is we've got a payoff diagram, which is kind of important to measure your risk, your expected, your payoff, your strike, and this is for your option. So this is really important because you can generate your premium and all that sort of stuff. I'm not going to get into this too much, but this is from the course that I learned back in about a month ago, the underlying relationship between options and futures. And this is pretty well, there's a lot of focus on this in these payoff diagrams. So let me kind of try to get you through the source code here. Okay, so we're here. All right, so what we do is we calculate our price of our stock, risk-free rate, the drift, the volatility, the strike, the option expiration, expectation, and a little few more other gold nuggets. So it goes in, does all these calculations. The webinar does it, kind of, sort of explains it all. But at the end of the day, this is what we get, is this payoff diagram. Okay. Again, I'm not going to get into it. There is a course that will show you how this is generated. But hey, I have it now. I have a way to generate it thanks to MathWorks and this webinar. So that's help number one. Now, the second diagram, I'm just going to kind of whiz through it and do a continue here. See what it displays. Not sure if that took effect. Oh no, it's still processing. But one of the other factors as part of this webinar is slippage. That's what I was going to show you in the next chart. We'll just start all over again. I'm going to set my breakpoints. Actually, it's a good exercise for people who can see how I do all this stuff in the editor. Okay, so we're here, I believe, at the payoff. Yeah, we are. Okay, so let me just run it to that point. Okay, so have we got our payoff? Here's our payoff diagram, so we can continue our way. All right, so let me just think. Yeah, this may take a while to generate. That might be why. Let me just yeah. So we'll see what happens here. Yeah, it's still processing. Wunderbar. Well, I'll just pause it and come back to it. Continuing along, we have our next plot that's created. Get our, I'm not sure if it's normalized, but it's some form of a distribution of uncovered versus covered wealth. You can see that this one's out of whack, which can say something about a strategy. Again, the webinar explains it all, but this is how all that code is generated. And I'm not going to get into that too much. So let's see what the next one generates. I believe this one focuses on slippage, but let me figure it out. Hang on here. Yeah, this is the slippage one with our efficient frontier coming through here. Again, all this is explained in the webinar. But maximum slippage, a function of strike and the probabilities. So that's pretty well that. I believe, no, that's the end of the script. But I just wanted to show you that this theory is a pretty important one. There's some very other useful scripts as well in these. The theory one I just showed you, and the other one I just ran this, which is supposed to run all these other ones. But hopefully this somewhat can give you a highlight of portfolio optimization, the importance of it. Talk to you later.